Good morning, everybody. A very warm welcome to Crypto in the Caribbean, threat or opportunity. My name is Dennis Augustine, and on behalf of the Caribbean Digital Finance Alliance, or CDFA, it's my great pleasure to welcome you today. We're thrilled to see such a remarkable turnout. I know in the audience today, we have senior representatives from the central banks, securities commissions, financial intelligence units, ministers of finance from across the region. We also have fintech innovators, leaders from commercial banks, compliance professionals, and advocates for the small and medium-sized businesses that are the lifeblood of our Caribbean economies. Your presence here underscores the urgency of this conversation. The CDFA is an independent alliance. We're dedicated to fostering safe, innovative, and inclusive digital finance for the Caribbean. We believe in the power of dialogue to navigate complex challenges, and that's precisely what we're going to focus on over the next 90 minutes. So let's set the scene. We're here to talk about virtual assets. Now, that can sound complicated, but at its core, we're talking about digital representations of value that can be traded or transferred. Think of them in a few broad categories. First of all, there are cryptocurrencies like Bitcoin. There are stable coins that are pegged or underwritten by things like the US dollar, and other digital tokens that can represent ownership of an asset or in a project. So why does this matter right now for the Caribbean? It matters because in our region and indeed across the world, governments and regulators are grappling with how to approach this new technology. We see a dynamic landscape. Some jurisdictions, like many of the Eastern Caribbean currency unions, have moved forward with licensing frameworks to supervise the sector. Others are actively considering different paths. The recent tabling of a virtual assets bill in Trinidad and Tobago, for example, has catalyzed this as a critical regional-wide discussion about the best path forward. Now, it's very important that I set some clear ground rules for this discussion. This webinar will not critique or interpret the specific text of any single piece of legislation currently under parliamentary consideration. Our purpose today is not to analyze a particular bill, but rather to use the broader regional and global experience to explore the fundamental policy question. In our Caribbean context, is it the more prudent posture to pause and prohibit virtual assets, or is it to proceed with caution under proportionate and risk-based approaches? To help us explore this, we're going to use some objectives-focused frameworks. We're going to focus on what we want to achieve together, whether it's protecting the integrity of our financial systems from illicit actors or fostering the kind of innovation that can solve real-world problems for our people. We want to ensure that our small businesses can survive and thrive in the digital economy. Our discussion will be grounded in these shared objectives. I'm so blessed that we have such an outstanding panel of experts to guide us through this complex terrain.
Mark Pareira is the founder of Zed Labs and Worx in Trinidad and Tobago. As an operator, he is at the forefront of this issue. He's seeing real world demand and the operational realities every single day. So he's going to ground us in the realities on the ground. Next, we'll turn to Annie Bertrand, my colleague at the CDFA. Annie has been deeply engaged with the evolution of the global AML, anti-money laundering, and CFT, countering the financing of terrorism standards from the Financial Action Task Force, in particular around the critical and often overlooked matter of financial inclusion. She's going to help us to understand the international context and the implications of FATF's latest guidance. And finally, we have Professor Louis de Coker, or Louis as he prefers to be called. Professor de Coker is a globally recognized expert on anti-money laundering law and has advised governments and institutions around the world on developing effective and pragmatic regulatory frameworks. He's going to share with us his deep expertise on practical pathways and potential pitfalls of different regulatory approaches. So let's begin. First to you, Mark. Can you help us paint a picture Setting aside any specific proposed legislation for a moment, what's the reality on the ground? Why are individuals, in particular small businesses in places like Trinidad and Tobago, turning to virtual assets? And what does the scale of that activity look like from your vantage point?
Thank you, Dennis. A very key point of Trinidad and Tobago is to understand something that was introduced in 1993, which is the managed float. That essentially means that the Central Bank of Trinidad and Tobago allocates US to banks, and then the banks will then distribute the US dollars to the private sector and economy and individuals. The distribution of that currency has not been transparent, but also, as you can imagine, in times like this, it generally favors the more fortunate. And what has been happening since 1993 is the growth of, because of this managed control and the Forex flows are lessening because of our reducing exports. Trinidad and Tobago has a rising black market. So that means that the central bank states that the rate is 6.78, but in the open market, individuals are finding creative ways to purchase US dollars outside of the banks. And what's the big problem of that? It's unregulated. And usually the people willing to take that risk are unregulated providers. Essentially, individuals and businesses purchasing US dollars peer-to-peer, which, as Louis will dig into, is where a lot of money laundering does happen. So that black market is not just individuals finding creative ways to get US, but it's giving rise to criminal industries and giving criminals a lot more power and economic validity. So fast forward to 2009, Bitcoin is created, and an entire financial innovation industry happens from there. Stable coins are created, which is essentially a cryptocurrency backed by the US dollar. So what that means is you've moved currency into this innovative rail and this innovative foundation, and individuals are now enabled to just download a wallet within seconds receive any amount of USD stablecoin. What does that mean for the Forex market? Is that it's even easier now to receive US. It's great for financial inclusion and for access to Forex, and that is currently how businesses in Trinidad and Tobago are finding Forex. We ourselves, because of the gray area in the virtual or the lack thereof of a virtual asset bill, this is also something that we do ourselves as we purchase cryptocurrency, which is a means of accessing Forex. And essentially what's happening now is that the small man and the small businesses who were enabling themselves with this access to Forex, this newfound democratized access to Forex, they're now being clamped down again, and we're going back to the previous situation where, the beneficiaries of the US from the allocations of the banks are again non-transparent, and then the small man and the small business are left holding their hands out to the sky and saying, what do we do here? So really and truly, what this means for the progress of a nation is that this blanket prohibition is also shutting out innovative providers of virtual assets. So there was informal routes, which did give birth to, let's just say, non-regulated and risky investment schemes. And I would attribute that to the lack of regulation. And then also there's innovative providers in Trinidad and Tobago who are offering virtual assets with compliance mechanisms built in. The birth of the industry has happened and they're moving towards regulation. However, this blanket ban is now being introduced. And for over 2 years, so it's until January 1st, 2028, is when they will unpause the blanket ban and allow industry players to start to offer virtual asset services. However, 2 years for a startup for an innovation sector is a death sentence. That's setting the context for exactly from a private sector and an industry's perspective as to what's currently going on in Trinidad and Tobago.
Now, Mark, you're a regulated provider and a regulated operator. So tell me, what sorts of information do you collect on your clients or monitor with your clients that might be helpful to a regulator in making sure that the system is safe and secure?
Yeah, being a regulated provider, in Trinidad and Tobago, we have rules to adhere to, but also from a business perspective, insights into our customers is invaluable when it comes to monitoring transactions, because as a business, you need to keep your systems clean and make sure that you're not aiding in assisting criminal activities. So what we do is we have a fully digital onboarding system. And we take everything from an individual's, we gather their ID information, so that's their first name, last name, their date of birth, their address. We even do facial recognition and liveliness checks. And then we operate within tiers as well with our KYC, is what this is called. Know your customers collecting ID on individuals. So we have a tiered approach, which is, again, another innovative approach where, let's say an individual does not have all the ID credentials. Maybe they migrated to the country for a better life. We still have that tier, which limits them in their amount of money they can spend, up to 7,000 TT, but allows them to digitize and be within a safe environment where they're not walking around with cash. So that is just collection of the first name, last name, and the residential address, as well as their date of birth and where they're born, but not verifying it. And every tier after that, if they want to engage with the banking sector, if they want to, let's say, purchase cryptocurrency or virtual assets one day, they'll have to verify their identity, which is their residential address, their first name, last name, a picture, a liveliness check. And if it's a business, then we require the beneficial owners, the certificate of incorporation, and the list goes on.
Thank you very much, Mark. It's a powerful illustration, I think, of both the demand. You're seeing a lot of demand for that in particular to help small and medium business facilitate trade. So that's obviously a powerful tool for that. And really, you've described it's significant. It's economically driven. The activity is already happening at scale. In our previous discussions, we've talked about the peer-to-peer transactions, as Louis has mentioned previously. So from your operational standpoint, and I'll thank, by the way, any of our other panelists if they'd like to chime in, and all of you on the call today, if you want to put your questions in the chat, our colleague from the CDFA, Melissa, will monitor that and raise some that are relevant to the discussion. But from your standpoint, Mark, the risk of these peer-to-peer transactions, can you perhaps speak a little bit to the peer-to-peer risk and how operators like yourself might help mitigate that?
Yeah, as we've been correctly informed by Professor De Croca, Louis said rightly that within the peer-to-peer market is where majority of money laundering takes place. And the peer-to-peer market in Trinidad and Tobago with the purchasing of cryptocurrencies is a completely non-transparent industry. So I'll give you an example. You take cash, which is a non-traceable asset issued by the central bank, which is not cryptocurrency, that's unique in the fact that it is used as a money laundering mechanism. Cash is also one of the biggest mechanisms for money laundering. So you take cash, which has high risk of money laundering, and then a peer-to-peer or an individual who has cryptocurrencies, this is also non-traceable if you do not have the KYC information that you can tie to that address of the individual. So you have two unidentifiable characters. One is pseudonymous, which means you can identify the address if you know whose address it is. But in this case, two totally anonymous individuals to the central bank. The government doesn't know if it's happening in Trinidad, out of Trinidad. And essentially, what having regulated providers allows is you on-ramp an individual through the wallet. The KYC that I just talked about is tied to the address of a peer-to-peer individual. And then once that individual transacts, if it's with cash on a peer-to-peer market, or if they trade it externally, you will then be able to see exactly who is the owner of the address. And then once these circles start to get tied together, you now have insight over the entire cryptocurrency trades that are maybe one or two layers of abstraction away from an individual who did on-ramp into crypto. So essentially what it means is no transparency, no insight into the industry currently. And with the blanket prohibition, the same exact thing. However, with regulated providers, you now can start to gain way more insight into the cryptocurrency trades because the blockchain is a completely transparent ledger. You can go onto the blockchain right now, with no login credentials, no API access, and just look at an account, see the balance, and see the transactions. So that's just how transparent cryptocurrency is, but you need just an insight into transparency by tying the address to KYC.
And that is a really interesting point when you start to understand the way that technology works. These peer-to-peer transactions being more in the dark, even things like cash transactions are not really transparent. I can hand anybody cash and I won't be able to trace that, but including folks in the digital ecosystem also adds to that transparency. I think that's a great transition over to our colleague and ringleader over at the CDFA, Annie Bertrand, joining us from Barbados today. And Annie, you've been involved in the evolution of the standards, particularly around financial inclusion. At FATF, recently, they published some financial inclusion guidelines. And why don't you let us know how that's relevant for our discussion today?
Great, excellent. Thank you so much, Dennis. Let me first, you see my screen?
Yes,
Because I
we do.
have some slides. So let me just briefly tell you a little bit about what is FATF. So the Financial Action Task Force essentially is the global financial watchdog. It has 40 members, but it expects that all countries comply to their standards. And their standards essentially involve 40 recommendations to prevent serious crimes. And here we're talking about money laundering, especially drug trafficking and human trafficking, terrorist financing, and proliferation financing, which relates to weapons of mass destructions. So all things we don't want on this planet. What's important to note is that FATF doesn't really have any legal authority on the countries, but it conducts what we call mutual evaluation reviews through either itself or through regional bodies. Like in the Caribbean, we have the Caribbean Financial Action Task Force. And they rate countries on their technical compliance to these standards. So they will look at if there are laws and regulations in place to comply with these standards. And not only if they are there, but if they are effectiveness. So do they impose sanctions to enforce the regulations? And if they fail, this has terrible economic consequences on the country because it increases the cost of capital. Sometimes it removes access to capital entirely. It reduces investments. And for us in the Caribbean, which is particularly important, is it can cut off our correspondent banking relationship. Now, over the years, FATF noticed an overcompliance to its standards, especially in developing countries. So in June of this year, FATF published new financial inclusion guidance and updated its recommendation. Essentially, it's saying that applying an overly cautious approach to AML-CFT standards, safeguards, can have unintended consequences of excluding legitimate businesses and consumers from the regulated financial system. So in the past, we thought like everybody was understood that financial inclusion was harming individuals and businesses. But now FATF emphasizes that financial exclusion actually represents a real risk to achieving the effective implementation of the FATF standards. Therefore, countries and financial institutions must implement measures to reduce financial exclusion. And if you look into the guidelines, you can find them online. They provide many examples from other countries where the risk-based approach has been implemented effectively, and they provide guidance also and examples on implementing simplified due diligence. Mark was explaining related to the tiered approach. But why is it so important? Essentially, exclusion affects financial integrity. So it limits transparency and it undermines the effectiveness of safeguards. So safeguards like wallet size or due diligence, whatever it is in place, because we cannot see them. And it increases the risk of crime. And fundamentally, such recognition is important because to me, it means reducing the black market, reducing the cash economy so that everyone can have access and benefit from the global digital financial system. But what is financial inclusion? So FATF published a new definition. So it's the access to and active use of an adequate suite of appropriate, safe, convenient, affordable financial services and products by individuals and entities that would benefit from such services. And again, if you go to paragraph 22 of the definition, you can also see additional information on how they define appropriate. Appropriate means tailored to customer needs, but also delivered transparently and fairly. So that brings us to my final slides about the different approaches to regulations. of virtual asset providers. So recommendation 15 is about new technologies. It's about regulating virtual asset service providers. And basically what it says is they must be regulated for combating money laundering, etc. They must also be risk assessments and risk-based supervision implemented as a result. And VASP must also be either licensed or registered. And small jurisdictions, oftentimes, they start with registration requirements because registration regime oftentimes is simpler to develop and manage initially. And it also enables some level of oversight, and it facilitates a more comprehensive risk assessment to better define the licensing framework and the risk-based supervision after. But given the challenges of regulating this industry, FATF issued additional guidance over the years to help countries define the most appropriate approach. And in 2021, FATF actually added that countries have the discretion to prohibit or limit virtual activities in their jurisdictions if they want to. Now, in the latest update on virtual asset and VASPs, published at the same time as the financial inclusion guidance, we found that the majority of jurisdictions have already a licensing or registration regime, but 20% of them have chosen to prohibit partially or fully the use of virtual assets and virtual asset service providers. This creates some concerns because FATF also realized now that implementing the prohibition is actually very difficult. In fact, they found that a recent assessment they published that results show that only one jurisdiction that took a prohibition approach has met the relevant requirements for recommendation 15. Given this new financial inclusion guidance that I just mentioned, perhaps this has revealed the importance of keeping financial activities in regulated channels. So perhaps the prohibition can create additional problems and concerns for FATF when conducting their mutual evaluation reviews. So I'll stop here. This is far from an exhausting review of the global financial framework, but I hope that this information can help you understand the context, but also engage in this fascinating discussion. Dennis, thank you so much, and over to you.
Thank you so much, Annie. Maybe just one quick follow-up. There's been a robust discussion in the chat, and this is exactly what this forum is really all about. Tell us, if you would, the relevance of FATF to the Caribbean. We might say we're sovereign nations, we can do our own thing. Why is the FATF regulation so relevant to the Caribbean, and what is the risks for us if we're not in alignment with those regulations?
But as I said, countries have committed to obey or apply and adopt these standards. So therefore, the FATF, what it does is, as I said, they do mutual evaluation reviews. And when they do this evaluation, they verify if the countries have the proper legislation and regulations in place to meet those standards. And when they find that the countries don't meet those standards, they blacklist them or gray list them. And when the countries are gray or blacklisted, this is when it has economic consequences of the country, because then the cost of capital increase, and then we may lose our correspondent banking relationship. So it has very negative consequences. So we don't have to obey if we don't have to, but if we don't, then we get blacklisted or graylisted, and then we have perhaps no corresponding banks. Perhaps we start living in isolation because we don't have access to capital and investments. So that's really the reason why we have to comply with them.
Thank you so much, Annie. I think it's a great context to have, and especially the perspective of the priority being financial inclusion. You mentioned during your presentation something that Louis has spoken about, which is having a register first sort of approach as being a great way to start that. And I wonder, Louis, we've discussed that things like the pause and prohibit approach. From your global experience, what are the common pitfalls of a strategy like pausing and prohibiting, and what are the alternative sort of pathways that we could follow? What's been working in other jurisdictions that we might want to look at here in the Caribbean?
Thank you, Dennis, and thank you also for this invitation. I have behind me sunrise in Melbourne, but it's actually 10:30 at night. And I'm not in Melbourne, I'm in Port Moresby in Papua New Guinea. The issues that you raise here are relevant globally. The developments in technology that we're dealing with are putting pressure on all governments and all regulators and all supervisors globally. more so in smaller jurisdictions, more so in smaller island jurisdictions, where the activity rate and capacity is often difficult to match. And that is why it's fully understandable that a pause or a ban might look like an attractive option. But it's an option filled with pitfalls. Let's first start with the pause. We haven't seen many examples of a pause. We've seen examples of bans, but not a pause. And a pause adds a further layer of complexity, because if you're running a business and you're being told that continuing to run the business now will become criminal, but in 2 years or 3 years' time, it won't be any longer, then there is a lot of incentive to think how to survive for the next 2 or 3 years. One choice is to continue in the jurisdiction and to challenge them. So you continue to act, but you take the regulator to court and drag the processes out in the hope that the clock runs out. We've seen that strategy being followed even where there wasn't a pause. The other possibility is just to up sticks and move to a different jurisdiction for the time being, because you've got a time frame. It is just a period that you need to survive. But it means from a regulatory perspective, it actually undermines the objectives of that regulation. But it's such a human response to such a pause that I think it should be considered with care. Coming to a ban, the problem with the ban is, and that was recognized by FATF from the start, is that it is also fairly resource intensive, because a ban can't just be imposed and then be left in place. It needs to be enforced and policed by government, so it requires resources. So instead of fintechs then in this space contributing to the economy, it becomes a cost, because you need to set regulatory resources aside to monitor that the ban isn't being breached. And that's one of the big reasons why so few countries that have followed this route have got a complete green tick of compliance from FATF. Because it's easy to adopt the bill, it's more difficult to resource this investigation and enforcement. And while you're doing that, because the market is developing globally, you also need to continue your assessment of risks. Furthermore, it means that most of the crypto activity that is relevant to your jurisdiction will be carried on outside of your jurisdiction, outside of your control. That disempowers you in relation to legitimate business. In relation to criminals, they're already breaking the law, so they are not necessarily going to comply with a ban. But as you mentioned, there is real concern that the vast majority of criminal funds involved in virtual assets follow the P2P route or unhosted wallets. And we're dealing here with currency that's been designed, or with an asset that's been designed not to require any intermediation. It's been designed for personal trading. What is regulated under the FATF standards are those who act as intermediaries. They add a lot of value to clients in this space, but they're not necessary. They're certainly not as necessary as banks, for instance, to the current fiat system. Therefore, if criminals don't want to subject themselves to that layer of transparency, to identification processes, to AML laws, they just deal with each other on a one-to-one basis through the dark web. And we've seen that. There are various mappings that have been done. Some says most of the criminal money is in unhosted wallets. This changes from year to year, especially as virtual assets are becoming mainstreamed in the economy. But it's clear that's a significant part of the criminal money. And that remains the option then. If you can't trade legitimately, then you just disappear into the dark web and into P2P trading, into unhosted wallets. And that doesn't strengthen financial integrity in the country. So it brings us back to what the regulatory objectives are. All of these options carry a cost, but some also hold some benefits. bans and especially pauses seem to hold perhaps the least benefit of all.
I think that your point with regards to the psychology of the situation is a really important one. We can get geeky about the legislations and the processes and whatnot, but your point around the justification when folks feel that they need to use these things or that they're going to be better for them financially if they're using those and they think it's going to come into, we're going to be allowed to do that a little bit later on. I think that is such an important point that we must consider the psychology of the folks who might not necessarily want to even break the law, but they're thinking it's going to be legal later on. So let me just get there. Now you've mentioned the resources, and that I'm sitting here in Dominica, the nature island of the Caribbean. We're a rather small nation, under 60,000 people supposedly on the island. Our resources are limited, and really, I think to all of you. Now, we've talked about the problems. We've talked about some risks. How do we, in particular, resource-constrained nations like we find here in Dominica, get to the point where we can have an effective regime in something that is so new, where we're trying to discover what are the practical steps that we can get from here to there. And I'll just ask each of you to help us make that a little bit more concrete, in particular for the benefit of the regulators that are on the call here today.
So interesting that the Caribbean Digital Finance Alliance was seeded from UN initiatives and UN stakeholders. So the UN has the PPP framework, which is essentially designed, the public-private partnership framework, which is designed to align public policy goals with private sector innovation. And why I keep pushing the PPP framework with our government, because it's an innovative approach, but it's also a great approach in terms of increasing your capacity with individuals who are on the ground, who are willing to work with you. And I think Trinidad actually is poised incredibly well to showcase the benefits of the PPP framework purely from just anecdotal evidence from this bill. So, for example, this bill was proposed. The reaction to the bill being proposed was that the Fintech Association of Trinidad and Tobago quickly mobilized, created a virtual asset working group, including stakeholders within the industry. So I think what the SEC and the central bank wanted to see was who is the players actually doing things in the industry. So a ban was put out and the industry players stepped up immediately. And you're seeing virtual finance, GWAP, WAM, Paywise, TT Exchange as all individuals that are part of the industry who are engaging in virtual asset exchanges, but also doing it the right way. KYCing on either end, adhering to the travel rule. Then we propose the virtual asset working group, and we end up sitting in front of the Minister of Finance and members of the SEC and FIU to engage in a proposal on how we amend the bill. And then there's maybe 2 or 3 simple additions that could allow a sandbox and already existing FIs to help engage in the regulatory frameworks that they're already adhering to move into a sandbox with the other players so that the central bank gains insight from industry, from the private sector, to then implement a progressive virtual asset bill. So that public-private partnership framework with the virtual asset working group of Trinidad and Tobago can bring in a sandbox, which is the risk-based approach that FATF recommends. And a simple approach, because the difference between the sandbox and prohibition is, as Louis mentioned, you're going to have to make the effort to prohibit. Putting out a blanket prohibition doesn't prevent it from happening. Again, if anything, it exacerbates the criminal activity. So why not increase your capacity with private sector and allow them to gain the insight? Because our enemy is the criminals too. So why we are going to work with you to fight the unregulated providers as well, because like we have shown that we are willing to become regulated to then offer virtual assets. So essentially, that is the approach that the Trinidad and Tobago government can take and look like global leaders adopting the PPP framework, adopting the risk-based approach from FATF, meeting IO3, which is the technical recommendations from FATF, by working with technical providers and then implementing a comprehensive and progressive virtual asset bill. And it's 2 or 3 amendments on the bill. It's nothing crazy, but it's a progressive approach to an incredible financial future.
I wanted to just add something. This is great because this is precisely what the Carbon Digital Finance Alliance is trying to do, right? We're trying to foster collaboration across sectors, not only within countries, but also across countries. So we're putting this seminar today together, building on the knowledge and expertise of also others around the world who can help us. So this collaboration is a starting point, and it's applaud Mark for making the extra efforts with the industry at the national level. But we can also, with the Carbon Digital Finance Alliance, leverage our relationships in each country. For example, in St. Kitts and Nevis, we do have a virtual asset business regulation that also allows registration at the moment. So we can tap into our relationships in St. Kitts and Nevis and say, look, can we share can we look at it and can we share our experience? Have this worked for you? What are the risks? What are the concerns? So we can leverage each other and also leverage our colleagues in the alliance all over the world. And I'm going to want to turn it over to Luis to see what he has to add to it.
Thank you. And thank you, Mark. I fully agree that a sound public-private partnership is a very important part of the solution. We can't expect small governments to build capacity on new technology and to be on top of the technology and the risks to the extent that those in their jurisdiction who are at the cutting edge of the technology in the field itself. And we also need to recognize that we need to be very careful of regulatory capture. But as long as that is positioned, there's a lot of space to collaborate. A sandbox may be a great idea if new technologies have to be tested, or linked to registration if it has to be used to enhance the test and learn approach. So you may recall a number of years ago when technologies started to emerge in this space, regulators first allowed action, but basically to see how it develops in the field and then to craft their regulation. That developed, or that spawned, the regulatory sandboxes that we now have. So somewhere in between, depending on the needs of the jurisdiction, depending on the maturity of the industry in that jurisdiction at that stage, there might be an answer in between those 2 points as to what would be the ideal. But it would be important to collaborate with industry experts in a way that empowers the government and the regulator, and not through regulatory capture disempowers. So it must be about empowerment. But for example, the government and the regulator requires the ability to monitor the market for any new players who should be registered and who are acting unregistered. That's where the industry can play a crucial role, because they've got their ear to the ground. They know their market. They speak to their customers who know about other options. That's a tremendous source of information that can be provided to government that lessens the burden on government to make available that capacity itself, but provides it with high-grade information, and with the market playing a role in ensuring that the right information is provided to the regulator. The idea of interjurisdictional collaboration in the space is also incredibly important for smaller jurisdictions. So not only collaborating with the market players in your jurisdiction, but also collaborating with the other regulators and the countries who are facing the same challenges that you are, is empowering.
I'm going to give a compulsory plug to the CDFA in that we have set up the CDFA to be a collaboration between innovators like Mark, regulators, financial institutions. These are all our constituents. I've seen some, including a question to Mark that we'll pose right after this. But for a moment, Mark, I want to get a little less academic, if you would, pardon me, with you, get a little bit more personal. I'm a person who loves to start businesses myself, and I know the grind can be difficult. I've been rather surprised to see, and I think the perception of crypto or blockchain advocates are, these are people who advocate for the Wild West. But as I've come to know you through the CDFA, we've seen that you've been very thoughtful about how you can make things work from a safety. You have some of the same goals, it seems, that the regulators and the audience will have. But on the personal note, if I may, what does something like the prohibitions that are being tabled at this point mean for you personally and for your journey and what all that you have invested in the space, and potentially what sort of an effect would it have in 2028 to the ability of the nation and indeed the regulators themselves to move forward?
So a brief history on my background is that the company Z Labs that I founded in 2018 in Sydney, Australia, is a blockchain company. Until 2024, our income was primarily cryptocurrencies. So I think it's an interesting take where also taking this blockchain-based company, we gained international notoriety. And once I gained an international clientele, that mobilized me from Sydney, Australia to meet my long life goal of coming back to Trinidad and making it a better place. Like, we're aligned in terms of making Trinidad a better country. And that's why everything that I do, I live and I breathe patriotism to push this country forward. If a blockchain-based company comes to Trinidad and Tobago who builds mobile wallets and starts to build a mobile wallet in Trinidad and Tobago and adheres to regulation, I think that's a big signal of what's to come in the future. And while people think that crypto is the Wild West, there's always opportunity in unregulated markets. As we've seen with the internet, there's bad actors and good actors. There's bad actors that drive on roads. There's good actors that drive on roads. Public infrastructure allows all players to exist. But if you inhibit the good players, essentially you start to give rise to the bad actors. And where this is public infrastructure and it's not going away, and this is enabling both good and bad actors. So in terms of me personally, what this does to me, for an individual who's come to Trinidad to innovate, I now have this, and this has not been an easy road. I just want to put that out there. Every step of the way in Trinidad and Tobago and running a startup has just been hurdle after hurdle. And then as a virtual asset company natively, I literally proposed the stable. We set up a meeting on the 28th of August with the central bank to propose a Trinidad and Tobago virtual asset. On the 18th of September, on the 12th of September, the bill comes up. So the timing is just horrible. And then what it does for me as a Trinidadian who's investing in the country, what does it mean for me? That's one of the biggest blows to me as a citizen who's trying to push forward the country. And blockchain has only been a mean for me to financially empower myself. And that's the goal for me to do it in Trinidad and Tobago. This is a co-working space that I developed, and I made it for Trinidad individuals in Trinidad and Tobago. Every single piece of furniture here was bought with a cryptocurrency asset because we couldn't get US from the banks. So in essence, when you think about that, like everything here, the essence of it is all Caribbean. We're pushing Caribbean forward. And the main thing about it that is really hurting me as an individual is step by step I've shown Trinidad that I want to push this place forward. And every single step of the way, we meet with regulators. I went on the stage in 2023 with the central bank to push forward the country and towards cryptocurrency. We've had so much consultations with the IMF, with the local industry, enough time to issue a virtual asset bill. However, we're now met at this time with a non-progressive bill that does not represent the innovations in the private sector. It does not represent the capabilities of Trinidadians. So that's where this hurts the most, is just you're pushing out innovation. And innovation, like cryptocurrency, is the most innovative asset in fintech. It's driving us into the future. Swift just announced that they're moving towards blockchain ledgers. The whole world is moving in that direction. So it's just that Trinidad and Tobago is not showcasing its potential with this bill. And that is the biggest red flag. And I'll tell you what, locally, the newspapers are lighting up right now with this crypto ban, and it hasn't been approved in Parliament yet. If it does, that's going to be a global issue. So I don't think coming with the budget, it's a good time for us to push a bill that's non-progressive, because we're not going to look good. Turks and Caicos issued yesterday, they're pushing a virtual asset bill. Bahamas, we have a small scam in Trinidad and Tobago that's making us up in arms. Bahamas had FTX, a global scam, where individuals were litigated and put in jail. And they still have a virtual asset bill that's progressive and years ahead of everyone else. So I think it's just a time to start to look at Trinidad and be like, we can more than do this. The timelines of FATF are nothing in comparison to our capabilities, and it's time to take a progressive step forward.
Mark, first of all, I'm really glad we asked you that, because I think it is very important, Annie, that we humanize these discussions about the impact that they have on individuals and our societies. Now, as a CDFA, we are trying to create this forum for this discussion. And of course, we also see the difficulties of what the regulators must be facing themselves in particular, just coming into this new sphere. So we have to be sensitive to that as well. But having folks like you, Mark, who are willing to participate in the discussion, and this is the thing I think is most important, that we include each other in this discussion, especially when I think, as I mentioned, we were at Fintech Islands not long ago, and we met with regulators, people in FSUs, bankers, and so forth. To a person, we found that we shared the same goals to move forward safely, and it's only going to happen through this sort of dialogue. Just to you, Annie, I mean, Mark has spoken to the impact of that on somebody like himself as an innovator. Can you maybe speak to the impact from a financial inclusion perspective on the individuals, and what sort of threats do we face from excluding people in that sense, and what kind of positive or negative impacts can these decisions have on the individuals? And then, Louis, I'd ask you as well, maybe comment on the previous statements, but also help us take the view of the regulator. How do we get there in an achievable way? And you've mentioned something that's very interesting about a register first, and perhaps not criminalizing the activity, but non-registration. I think that's an interesting approach, and I'd love for you to talk about that in the context of the test and evolve sort of mentality that you've proposed. Annie, if you would.
Yes, I want to just say that I've been working in financial inclusion in the region for many years, and I've been training financial institutions and regulators, financial regulators also, on the new financial inclusion guidance in other areas. So it is incredibly important, and we understand that, all of us that are in this meeting today. But the problem is that the technical requirements to make progress in this space are very high. All of the financial authorities that I've worked with are highly competent individuals and understand the process. But if you dig deeper into understanding how to implement those simplified due diligence, for example, there's a lot of things that it involves, a lot of things. For example, it has to be based on national risk assessment. And the national risk assessment is not just, oh, we recognize that these enterprises involve low risk of money laundering and nobody's involved in financing terrorists. So it's beyond that. It has to be all documented properly using specific additional guidance. So when we say it's a white collar sort of an issue, it is because it requires a lot of documentation, a lot of wording, a lot of assessments that makes it difficult for regulators to comply within a certain time frame. But the reason I'm happy about these new official financial inclusion guidance of FATF is now it makes the whole aspects more related to international development. And we're going to see hopefully more international development organizations being willing to build the capacity, not just of the MSMEs directly, but also the capacity of the regulators so that they can serve MSMEs more effectively using digital financial services, including cryptocurrencies. So
thank you so much, Annie. Louis, I'd love you to chime in, and right after Melissa, if you would, you're going to come on right after that and let us know about any questions that we might have that we want to field at this time as well. So folks, if you have questions, do put them in the chat or message them directly to Melissa Boutin there, who's been paying attention as much best she can. Louis, if you would.
Thank you, Dennis. We're addressing different tensions here. The crypto market is now with, I think, around $4 trillion US. It is huge. It is now part of the mainstream financial system. All countries need to respond to that. But there's a particular challenge for a small jurisdiction. So if you've got 60,000 people, you're probably speaking about one regulator, perhaps two, perhaps a fraction of a regulator having to look after this important part of the market. So I fully understand the need for caution. But I think the best starting point is getting a good idea of who is in the space. How many providers are there? And that you do through a registration process. It's not a licensing process, and it's allowed by FATF to choose either registration or licensing. It means people follow their business details with you as businesses that provide virtual asset services. That's a great starting point, because then you know what the community looks like. You may have 2 businesses, you may have 20, you may have 200. It gives you a starting point to plan. And I do think that needs to be combined with some consumer education, because we're seeing a rise in scams, we're seeing a rise in losses, we're seeing a rise in fraud in general. So it's important to make it clear to people that registration is not an endorsement. It's just mere registration, and they need to be careful. This is still a market for people with a level of sophistication in terms of understanding of the products. So I think that is an important message going out from regulators until matters have stabilized. So using a building block process, once you've registered, once you know who you're dealing with, you can start forming that public-private partnership. I've also seen a number of comments around sandboxing and whether sandboxing is appropriate or not. And I just want to point out that sandboxing is not about the idea. Many of the ideas have now been tested in other countries. It's about testing your regulation in relation to that model, because it may work beautifully elsewhere, but you may have gaps in your system and you're not aware of them until you test it. The other option is you allow it, and then through trial and error, you discover where the weaknesses are. That's not ideal. So the sandbox is, from that perspective, ideal to test what is required in the laws of a small country, what is required in terms of regulatory capacity in the country. And I also mentioned what might be required in terms of registration fees, because regulation will require resources, and ideally those who apply for registration should fund the regulatory costs involved. But what is a reasonable fee? Again, start with scoping and registration. Thank you, Dennis.
Thank you. I actually surprisingly saw Mark nod his head slightly when he said about those being should bear the cost. I'm stunned, but he understands that as an investment. I think we at the CDFA as well, from an education standpoint, understand that's part of our roles. If you would like to continue to be engaged with the CDFA, go to CaribbeanDigitalFinance.org. There is a pre-registration there. So we're just getting going with that. And later on, we'll engage with you. You'll have the opportunity to receive some member-only benefits that you'll see on that site at the /membership page. Sign up there as well. Follow us on LinkedIn as well, so you can be part of this dialogue, because it will take all of us collectively to come to the right solutions. Louis, I'm a geek myself, but not in terms of policy and the legal aspect, but with regards to software and digital. And we have something that's been working well over the last 20, 30 years, more agile software development, where we'll try to start with something small and achievable, learn rapidly, and iterate quickly. And we found that's perhaps one of the most effective ways to make inroads with technology. And just from your nodding, I think is probably also a really great way to make inroads with policy, because no plan is going to survive encounters with reality. You have to put it into place, learn, and adapt quickly. And certainly with something as fast-paced as crypto, and we're going to have to do that. Melissa, if you would, take yourself off mute. Is there any questions that you want to really... Marcus got his hand up. He wants to make a comment, and then Melissa, you can mention the question.
Yeah, I just want to answer to what you just pointed out, that we're willing to pay the price. When you look at just the brass tacks of it all as a business, and you think of the country as a business, we understand there's maintenance that needs to happen. There's regulations that need to happen. These are all costs that businesses have to do as well. We are 100% willing to pay tax, obviously. And just from rudimentary calculations, because of how lucrative this industry can be and beneficial to the economy, this will more than pay for the regulators and public infrastructure that is required to regulate virtual assets. So it's not going to be something that's a major burden on Trinidad and Tobago. It's actually, for the regulators, going to be less of a burden financially because of the income that it does bring into the country. So just to note that this is something we have considered and offered up to the Ministry of Finance.
It's nice to see that you're willing to play on the team, Mark. This is a success in the Caribbean. I fully believe is going to be a team sport. Every nation, all the different stakeholders working together. We're in this boat together. Melissa, if you would, any questions that we want to pose to? our panelists.
There, hi, Melissa. Not many questions, but there was some earlier. One asking, I guess this may be for Louis, which one jurisdiction was successful with prohibition? I'm not sure if you can answer that or anyone else on the panel.
That was said by Annie, actually.
Yeah, in the latest report, the latest update at FATF on virtual asset, on the regulation of virtual assets and VASPs, the latest finding is that one jurisdiction has successfully met the compliance requirements of FATF using the prohibition approach. But it depends also, your question is not clear in a sense that how do you define success? So if the success is to meet the requirements of FATF is one thing, if the success is to reduce money laundering and financing of terrorism, it's another thing. But so far as what we have found, based on the surveys that FATF conducted, I think it's about 163 jurisdictions around the world, only one of those who did the prohibition approach met the requirements of FATF, of recommendation 15, going forward. So what it means is that the countries seems to not being able to implement the prohibition successfully because it requires identifying the stakeholders, it requires implementing sanctions, and these involves a lot of resources and challenges to do. So I think what I expect is that FATF will be a bit more stronger in making sure that the countries take the route of regulation as opposed to prohibition, because clearly the experience around the world have shown that implementing a prohibition effectively can be done, given the challenges.
And Annie, do you know which jurisdiction that was, or I guess we could reference the report?
No, but the report, I'm going to show the report in the chat. I'm going to show the link. But
Okay.
the survey, the information that FATF collects from its countries is confidential. So they're not going to necessarily reveal who has done what and what has
Understood.
But the information is there and it can be analyzed thoroughly because the report is quite extensive.
Thank you. And I did note a question from Jaron Paul in the chat for Mark. Who should be allowed to join this sandbox that you're mentioning? What kinds of businesses? Who should have access to this sandbox in your view?
Okay, so I want to bring home what Louis has mentioned. Louis mentioned a registration approach, which is even lighter than the sandbox, where you bring visibility over the industry players. That to me is the most ideal approach because you have existing players who are currently operating allowed to come into visibility with the regulators. And the other side of things is that after being registered, that currently is within the bill, is that you have to declare that you're a virtual asset. You've been providing virtual asset services. However, after that, you have 3 months to cease operations. So it's more of a registration to be able to be admitted into the sandbox, which is an approach that I favor. Reason being is that, so if you just look at baseline operations as a financial institution, there in Trinidad and Tobago, that there are a lot of things that help protect your customers and the citizens of Trinidad and Tobago. That is having a board of directors, that is appointing a compliance officer, that is customer due diligence, enhanced due diligence, that is making sure that you are in adherence with policies and procedures within your organization, that is auditing and reporting, record keeping, making sure that your technology that you're using is up to standard, isn't at risk of being compromised. And along with that is the transaction monitoring and reporting. So these are the baseline recommendations for financial institutions globally. And that is something that I think would need to be met by virtual asset service providers. And that I think would be terms in which the sandbox governs. However, the sandbox can allow individuals to get up to speed to meet those requirements so that you can rightfully offer these services safely to the citizens of Trinidad and Tobago.
Now, that's interesting. You've mentioned some kind of pre-existing frameworks for financial service providers in general, financial institutions. So there's perhaps a way to as well then look at you're providing a financial service. Virtual assets notwithstanding, you're providing a financial service. So there's some frameworks that you have to adapt, you have to comply with in any case. So perhaps that you want to comment on what sorts of things that are already in place widely throughout the region, even pre-virtual assets that could help start there with some level of rigor. It might be things like KYC and et cetera. what are the bits, because we're trying to plot a progressive path towards this that's manageable for people. So what's already in place that can be adapted to the virtual sphere that can give these regulators some more confidence and to give innovators some clear guidelines as we plot out the path to the future?
So, Dennis, if I can jump in there.
Yes, please.
Virtual asset service providers in normal business, it needs to comply with all of the normal laws that a business needs to comply with. That's the starting point. If it's a company, it needs to comply with the company law that applies in the jurisdiction. If on top of its services, it provides financial advice, that triggers compliance with any laws that regulate financial advice in the jurisdiction. The registration process that I've mentioned is registration for purposes of AML/CFT law compliance. That is also accepted as a given.
Annie, if you can maybe continue where he's left off, what sorts of things are already in place from a financial institution perspective that's going to start to set that framework that we can perhaps piggyback on? Service providers, financial institutions, where Louis had started talking about a progressive path towards that. How would you see, especially resource-constrained jurisdictions that might already have existing laws, starting to plot that path towards a virtual asset kind of regime?
Mark, you were talking about, do you want to continue?
Yeah, this is actually a part of one of the red lines that we did implement in our proposal to the amendments to the bill. It essentially is that existing providers should be able to, existing financial institutions who meet these baseline requirements should almost get a shoe into the sandbox, essentially. And that way you meet one of the FATF requirements, which is IO3, which is the technicality of the regulation, so that you as a financial or virtual asset service provider get shoot in and meet the requirements, so that if you are existing operator and you wish to operate as a virtual asset service provider, you apply that to your existing framework. And us as MIs, we report weekly to the central bank. So additionally, on top of that, we can just fit that into our reporting. And that would meet immediately needs of a technical sandbox.
Yeah,
Sorry.
The regulation is important to help the fintech service providers have access to the financial services that they need. And because we have seen in the Caribbean in particular, this de-banking, it's beyond just de-risking, because they just sometimes don't want to manage risk, because it's difficult to manage risk when you don't have regulation to assess the risk against of. So de-banking is a problem in the Caribbean, but not unique to the Caribbean. Banks refusing to serve fintech, but that is a problem for the perspective of financial inclusion. In the new financial inclusion guidance that FATF issued, they specifically address the problem of de-risking and de-banking, and they are encouraging countries to address those concerns, and meaning that when a company is considered high risk for whatever reasons, based on their own institutional national risk assessment or the risk assessment of the customer, which could be a fintech, which could be a crypto, a VASP, when they consider that the VASP, for example, is high risk, then they can implement enhanced customer due diligence for that VASP, meaning that they could maybe limit some transactions level, they could limit the wallet size, they could verify certain additional things on the criminal records of these entities. So there's a lot of things that can be done when the VASP is considered high risk in order to service them. The same thing applied for the VASP itself. When they're recognizing that some of their customers are high risk, then they can implement different risk mitigation measures to ensure that their customers are not engaged in money laundering and financing of terrorism. So to answer your question, the whole world is moving towards reducing de-banking and de-risking, and the financial inclusion guidance provide examples. Just one example, in Australia, the regulators have actually officially launched new guidance and recommended banks to stop their approach and start revising their risk mitigation strategies for ensuring that VASP gets the services that they need to serve the last miles. This is the context internationally.
Thank you so much, Annie. Mark, there's a follow-up on the point about the sandbox. Should only EMIs, I suppose that is electronic money issuers in TNT, I guess specifically in the TNT context, be able to be admitted to this registration sandbox?
No, I think what I said needs to be explained a little more. Only every single player who currently is offering virtual asset services should be allowed to, as Louis mentioned, register. And then within that registration, move towards still being operated, I guess, with light approvals. And so that's like the baseline that we're fighting for, is that all virtual asset service providers should be allowed to continue operations. However, one of the purposes of prohibition was to disallow the continuation of cryptocurrency operations. And to monitor that is not a light lift for the government. What we are offering is a lighter lift and an amendment to the bill, which is simply Clause 4.4 states that a license or certificate of registration issued under another written law prior to the commencement of this act shall not be considered as permitting an activity under subsection 2. What this means is that they're stating that existing financial institutions cannot offer virtual asset service, cannot become a VASP just out the box, and they cannot offer these services. What we're stating is that is also another heavy statement along with the ban, and that if you amend the bill and state that a license or a certificate of registration issued under the law, it would allow another entity already subject to supervision, provided such activity is conducted within and subject to the conditions of the regulatory sandbox. So we will have to, under registration or sandbox, meet certain requirements that already existing financial institutions have checked major boxes, and that will be a lighter lift for the governing bodies. And that is an approach to help with the capacity of regulating virtual asset service providers so that we can immediately meet the demands of the FATF requirements. So there's all developments that are happening. Our main goal is to have the virtual asset service providers exist in their current form, but obviously as financial institutions along the way, you will have to meet basic requirements of an FI. That is just a development in the future that could happen. So that, yeah, that's just not to be misquoted in terms of us
Absolutely.
being an EMI and biased towards allowing us.
So financial institutions have the role to play. You're talking about even increasing that competition environment, and that is a healthy thing for innovation. We're going to start to wind up here. I would just give each of our panelists a chance to make some final remarks, and then we're going to invite Edward Maferno from the UNCDF to have some closing remarks. We're so thankful to have the help of the UNCDF in establishing the CDFA. It is a forum, as we've said before, that we can engage in some discussions that perhaps some of us in our regular day jobs, be it in ministries of finance, institutions that regulators can't really engage on. So this is a nice safe space for us to have that conversation. We thank the UNCDF for their help there. But let's wrap it up and start to wrap it up. And Louis, Annie, Mark, if you would, let's just go in reverse order, and then we'll hand over to Edward. I want to thank each of you on behalf of the CDFA. I want to reiterate our commitment to being a partner in these vital conversations. So we're here to make this a safe, innovative, and inclusive digital financial ecosystem in the Caribbean. And if you're interested in coming along for that journey with us, I want to thank you. There's been almost 100 people in this call, right at the top of our limit of our particular Zoom account. We're going to need a bigger Zoom room the next time around, Annie. But if you're interested in continuing with us along this important discussion, go to caribbeandigitalfinance.org/membership and check out what it will entail when we launch that membership program. But Louis, Annie, Mark, and then Edward, why don't you take us home?
Thank you very much for the invitation to join you. I'm very excited about the collaboration that has run through as a golden line in the remarks. The offer to participate in the discussion and to highlight risks and benefits and possible alternatives to help inform regulators who are really under pressure to make the right decisions. No one, and certainly no regulator, wants to make the wrong decision, but they are under pressure to take action. And they are under pressure because consumers are being defrauded. there is money laundering happening, there is terrorist financing happening. So joining them in the way that this forum has been constructed and the discussion conducted is, I think, a very constructive way for the Caribbean to move forward. And good luck on that journey.
Thank you, Louis. It's a pleasure to have folks like you along with the Journey allies from across the sea and the rest. Thanks for staying up with us, and we'll enjoy your evening. Annie, would you
Yes.
give us your
Yes,
remarks?
thank you so much, Dennis. I'm actually very excited because I think this kind of forum is exactly what we want to do at the CDFA. And we didn't even launch yet, but we still felt that it was important to facilitate this discussion because of what is happening right now in Trinidad and Tobago. But essentially, the Caribbean Digital Alliance, we went through an accelerator program organized and delivered by the Global Alliance of Fintech Associations. And when I went through this program with my co-founders, I realized that talking with the other fintech associations around the world, that this is one of the main value added of a fintech association, of an alliance like us, because it's the idea that now the regulators, whenever they issue new directives or they want to issue new regulations or supervisory framework, they reach out to that fintech association or that digital finance alliance to get feedback. And that's the most important, that's the value added, because it facilitates the collaboration and it avoids the regulatory capture that Luis mentioned that sometimes regulators may have. And in the Caribbean region, it's even more important because realistically, we're not going to have a fintech association that is strong enough to support the regulators effectively in each island. We're too small. So having this alliance together among the different countries, and we define the Caribbean by being an island in the Caribbean Sea or a member of CARICOM. So essentially, once we are now in the process of, we've just got our registration. This is our first activity, but after that we have done the official launch, we'll be able to invite members to collaborate and support our efforts so that we can have legal advisors in our team that are constantly reviewing those directives and also facilitating the harmonization of these regulations as they evolve across the different countries in our region.
Thank you. Annie from Barbados, Dennis over here in Dominica. Freedom of travel started between Dominica, Belize, Barbados, and St. Vincent and the Grenadines just yesterday, underscoring again the need for us to collaborate and to get things in a consistent manner as much as possible, our particular national context notwithstanding. But yes, Annie, we're excited to go along this journey. And so thank you so much for leading us to establish the CDFA. And of course, thanks to colleagues like our friend Mark here. Mark, why don't you give us a closing remark?
Yeah, I think it's great to see that we're all stakeholders in this and we're aiming for progressive regulations. And the main goal is to really innovate and provide means of diversification for our nation. This is one of the most promising elements for emerging markets for financial freedom. And it goes all the way up to corresponding banking relationships, this now provides a mechanism to help us stand alone and represent our currencies on different financial rails. It's thus liberating our currencies, thus liberating our people. And how great would it be if we all had our own island nations' currencies on a blockchain that we can swap freely with each other rather than have to go on a SWIFT rail up to US and back down, paying $40 US up and $40 US down, giving away 15% of our transaction fees to a slower, archaic, and restrictive rail. This is a liberating instrument for us, not just financially. I think it's time that we all band together and really push for this. And let us work with the regulators in Trinidad and Tobago and push them and bring them up with us to meet the other Caribbean island nations and twin island nations of the Caribbean that are progressing and making innovative strides towards regulation. So again, I love that we're banding together, especially in the Caribbean Digital Finance Alliance. And this is just a great next step for the future.
Mark, I'm so glad that we're wrapping this panel up with that kind of very optimistic note about liberation, something that should be so near and dear to each of us here in the Caribbean, given our history and the belief that, not just belief, the understanding that we can do it together. This is fully within our capabilities to do. If we come together, we can plug some of that leaky hole in our financial systems by leveraging these innovations, and we can start to empower folks. And so I really want to thank each of you, Mark, Annie, Louis, for your contributions here today. And of course, each of you have, almost 100 of you who have joined, please do spread the word about the Caribbean Digital Finance Alliance. We're looking forward to having you to join the conversation. We're looking forward to supporting our various jurisdictions. And let's just, right now, we're going to call on Edward to take us home, give us some closing remarks. And Edward, I joked with you that I hope that you're going to have your proud daddy moment with regards to the CDFA and what we're able to do. On behalf of the UN CDF, why don't you close us out here today?
Thanks so much, Dennis, and everyone. I think, first of all, let me take this opportunity to thank our distinguished panelists, Mark, Annie, and Professor Louis, for such a rich and insightful discussion. And to our audience, thank you for your excellent questions and deep engagements throughout the session. I'm also happy to notice participation from the Financial Alliance from Haiti. I think let's take that participation seriously and see how best we can collaborate. One of the things that you try to do is just to summarize what are the key themes of the conversation, just to make a summary. But I want to emphasize that today's webinar was organized by the CDFA, the Caribbean Digital Financial Alliance, and this is an independent body that has emerged from the UN CDF work on digital financial inclusion in the Caribbean. One of the core objectives for the CDFA is to converge a diverse of players across the financial sector, from fintechs and banks to regulators and the civil society, to speak with one voice in a dialogue with policymakers and government across the region. For me, it has been a very exciting and insightful. I think we are now doing a 90-minute one, and I think I have summarized 4 key themes that have come out clearly, supported both by global as well as regional best practices. First, I think we have heard the real and growing use and demand of virtual assets, especially among SMEs. This is not in the distant future. This is a present day reality, and we have to acknowledge that. The second thing that I have heard is the need for regulatory clarity, which also has been underscored. Ambiguity can stifle innovation. Precision in language of what we are writing is essential for building effective frameworks. The third thing that I noticed was how we have explored a range of practical risk-based tools available to policymakers, from simple registration to dynamic sandbox and phased licensing within the virtual assets. I think we cannot overemphasize that these risk-based tools offer constructive pathways to engage with the digital financial services and products safely. Finally, as a fourth theme that I've gathered is how we return to a core issue of transparency and visibility in everything that we do. We need to notice that effective regulation brings activity to light, where it can be monitored, understood, and supervised, and ultimately strengthening the financial integrity of our system. Ladies and gentlemen, I want to assure you that the UN CDF DFS Forense is committed to continue building capacity in virtual assets and regulations in the financial sector. This is something that we have been doing since 2022 in the region, and we are committed to continue to do that. We are also committed to support innovative risk-based approaches to financial service regulation in the region. Finally, in the interest of time, as we look ahead, I'm pleased to share that the official launch of the CDFA is tentatively scheduled for November 2025, and we will be communicating to all our stakeholders in due time. We want to, again, warmly invite all stakeholders, whether you're a fintech innovator, a financial institution, a policymaker, or a civil society advocate, to join the CDFA and be part of shaping the future of digital financial services in the region. Once again, I want to thank you all and looking forward to continue these important conversations with you all. I would end here, Dennis, and over to you. Thank you.
Thank you. I think there's no more words that need to be said other than to say thank you for each of you. We've had wonderful responses in the chats and via emojis and whatnot. And we're just really looking forward to seeing you the next time for our official launch in November. Thank you all. Thank you, Louis. Thank you, Annie. Thank you, Mark. Thank you, Edward and the UN CDF. And thank you all. Thank you, Melissa, for your assistance as well in the chat. Have a great day, everybody. Let's go forward and be productive together.
And thank you, Dennis, for moderating.
A real pleasure. A real pleasure. Anytime.
Bye.
Excellent job. Thank you.